Hello, everybody. This is Kim Arthur coming at you from San Francisco. I've got two of my founding partners, Dick Fredericks and Jim Concidine, that I'm really pleased that we're here to talk to you. It's difficult times to say the least out there, but just a quick thing. You got 135 years of market experience on this podcast. Uh, Dick, Jimmy, and I have worked together here at Maine for 20 years. It's our 20th anniversary. And before I jump into this, two of the three of us are from the Bay Area. I got to give a shout out to the Golden State Warriors. That's their fourth championship that they've just had. And who says that money can't buy you a championship? They have a salary and luxury tax this year of $346 million. That's 38% above the number two team. And next year, they're proposed to take that up to $475 million, another 37%. So money can buy you stuff. Anyway, let's jump into this thing here. We want to talk a little bit about the volatility in the market. Jimmy, what are you seeing out there? You've been doing this for 50 years. What are you seeing out there?
Well, I think you're seeing sort of schizophrenia. The volatility is higher than I've ever seen it in these short periods of time. I mean, it's unheard of to see the big market itself, drop 6% in a week. That's just sort of unheard of, and even in those bear markets of the past. With the exception of 1987, perhaps. But at any rate, yeah, it's been very volatile, very difficult to try to trade this kind of a market. It's almost impossible, and it goes back to the philosophy that it's sort of don't try to time the market. It's more important to be timing in the market rather than trying to time the market. And I think this particular period proves it more so than anything in recent history.
Yeah, isn't that the case? Dick, we've got inflation raging out there. We've got a Fed that's putting its foot on the brakes. What's an investor to do?
Well, like Jimmy said, in terms of stock market volatility, we've certainly had economic volatility as well, and it was exacerbated obviously by the pandemic. So we went from a fairly robust economy straight down, straight back up, and now we're reeling again with the inflation that has been created by monetary policy that was just as volatile as stock market volatility. And so now I in my lens, I think that I believe that bad news actually is good news in the sense that I want Powell to get this over with as quick as possible. I think he is late to the party. He's been late to the party, and I think he's finally gotten religion. And I believe that he will be aggressive at trying to tamp down inflation through rate hikes. And I think that's the lens that I'm looking at right now is faster is better than slower to put it behind us.
What about Jimmy, housing? We're coming into this downturn here where the average equity is 70% versus the last housing bubble, which happened when they only had 60%, and then housing prices went down 30% and got people upside down. So what are you thinking about the housing? What are we going to get, more of a garden variety correction, or is this another 2005?
No, I think housing's already rolled over. Prices have quit going up. The interest rates, as you know, the long rates for mortgages have gone from a little over 3 to a tiny bit over 6 in some places. So that housing starts are coming down quite dramatically. Housing turnover of existing homes is coming down. And so, what cures high prices are high prices. And so they've already rolled over, and the price of lumber's rolled over, down 40% from its highs or thereabouts. So I think the Fed is going to be surprised at how quickly things are starting to slow down. And I think that a lot of that's due to the price of energy, the price of gasoline, the price of food. And retail sales came out last week, and they were disappointing to some. And I think the Fed might find out by the end of the summer that the economy has slowed down rather dramatically, and they won't have to be aggressive throughout the end of the year. September might be, a lot less than 75 basis points increase. I don't think anybody's thinking they'll probably need that. But anyway, it seems to me that the economy is already slowing down, and inflation numbers are rolling over with the exception of energy. And that I would expect there'll be some demand destruction with gasoline at over $5 across the country, and in California where you are, over $6 in most places, if not higher. So that's going to start to dampen driving and the use of energy, and that's all going to flow through to these inflation numbers. So I think a lot of the stuff is starting to happen. A lot of the slowdown is starting to happen already. So if we're not in a recession already, we're very close to it. And I think the stock market's already discounted that. The stock market seems to have discounted the fact that we're going to have a hard landing. And I think the stock market is afraid right now, perhaps, that we're going to be afraid in the future that the Fed's going to be too aggressive and not recognize the economy has slowed down. That'll be our next fear. Right now, we're afraid they're behind the eight ball, being slow to the party. And then I'm afraid in the future, we might be afraid to get too aggressive and don't lighten up soon enough. So anyway, you watch the 10-year Treasury, it's already rolled over from its peak, and interest rates have come down in the last week. And I think people are starting to realize that things are slowing down.
Like the market, obviously, as we always love to talk about, price and proof rarely happen at the same time. Like you said, home prices are still, tacking at all-time highs right now, but the home builder stocks, they're down 41% from peak to trough. They've been in a raging bear market doing what the market's supposed to do, anticipating the future. So once those housing prices start to actually roll, you could actually, once rates have peaked, you could actually start to see those home builders pick up. It's interesting. I was just thinking with one of the things you guys were saying that the last time a Federal Reserve had to raise rates with inflation where it is now above 6% was 1977. Now that was under Burns, but that was such a different time there. They spent 2 years, 27 rate hikes, 27 rate hikes. And inflation didn't peak until the very, 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 very end. It's interesting. The markets were down 12 when they started for the first year. Then they went up 1, then they went up 12. And then for the bonus year after they were done raising, they were up 25 when you actually had a recession going on. But this time it's clearly, like you guys are saying here, we have an accelerated rate hike cycle, and inflation could actually be peaking right now at the front end of the rate hikes that are going on, and the market's doing this discounting. So very interesting. Jimmy, when you're kind of looking through, kind of looking through all the things that you look at here, what are you seeing for green shoots that are out there in terms of other inflation metrics? Are they still accelerating, or are we kind of seeing ex oil a potential peaking inflation?
Yeah, I think if you look at most of the indexes, including, which surprised me, I had checked this out just yesterday, that the food indexes, the commodity for the agricultural indexes have rolled over as well. So almost every index has rolled over, with the exception of oil, and that's down to $10, $11 a barrel in the last week or so. So it seems to me that the inflation numbers have weakened a lot. And they're going to continue to weaken as the demand is being destroyed because of the high price of energy amongst, and as well as food, but they seemed to have rolled over. So those are the best green shoots you can see. 2, 1, inflation commodity indexes have rolled over, and 2, the 10-year Treasury seemed to have reached a peak last week and has rolled over as well. And that probably tells you the 10-year Treasury action in 5 years probably tells you more than any of these other indexes that we're looking at as far as what the expectations are for inflation.
Yeah, and that's so important because the consumer sentiment index, which is at a all-time low, going back to when they started printing these numbers in the mid-50s, is highly, highly geared towards inflation. And obviously what the biggest driver there is gas prices. So if that thing is hopefully finding a bottom, historically, the forward 12 months move in the stock market when you have these lows in consumer sentiment index is 20%. So it's a pretty healthy move. You just don't know where that bottom finally comes. And that's juxtaposed to the consumer confidence, which is geared towards employment, which obviously, if we're going into a recession, that'll start to fade off, but that's coming from a much higher level. So that's very, very interesting. Recently, there was a survey that over a quarter, and this is building every day now, a quarter of U.S. companies are either firing, freezing, or slowing hiring. So they are switching from that warehousing to being very aggressive on cost cutting. I think that's one thing that people underestimate. Just like during COVID, companies don't sit there idly. 60% of CEOs are planning for a recession because they're paid to look out 12 to 18 months, where a consumer looks out 1 to 3 months, maybe. So there is a lot that's happening there. People forget that these corporations can tighten expenses very quickly, change, substitutions just like consumers do. So very interesting. I throw in one other thing on the green shoots, and then I want to get to some actionable items for people. I would look at not all groups bottom at the same time here. And we saw the last two bear markets in tech bottom 4 to 6 months before. And if you look right now, remember, a lot of tech stocks they peaked over a year ago, well over a year ago, as opposed to the bear market and the stock market that started in January. But we're seeing green shoots and things like biotech that's already up 8-9% off of its lows. The poster child would be FedEx that went down 40% from peak to trough. That's anticipated a bear market starting in May of last year. It's up almost 20% off the lows. And oh, by the way, it gave you a bonus. It hiked the dividend by 50%. So there's a lot of planning that's happened before that. So maybe if we kind of look at this, Jimmy, let's pull this back to the market.
Well, I think, first of all, we didn't mention when we talked about the economy, we should have mentioned that it's very difficult to have any kind of a recession when you have 3.6% unemployment rate rather. Most of these recessions in the past, they had unemployment at 14% at the top a couple of years back. 9% would be not unusual going into a recession. We got 3.6, so there's an awful lot of people still working that are going to, help to keep that consumer spending number up to the point. If we do have a slowdown, it doesn't look like it's going to be dramatic. Anyway, getting back to the stock market, if we went through all of those different periods, which I did, and of course I was never smart enough to sell, and I always kicked myself in the rear thinking halfway through it, why didn't I sell something? I knew that there was going to be a setback, but I always think, well, it isn't going to be that bad. It'll only drop 10 or 15%. Well, now all of a sudden you're down 20 and 30 in tech stocks. It's too late to sell now. Maybe it's a little early to buy, but we're getting so close to what could be the ultimate bottom that it doesn't make a lot of sense to not to figure out when you can start to add to your positions. I think the average time to get back to the high level marks, you might have to wait 2 or 3 years. Some cases it's less, but most of the time it's within 2 or 3 years, the averages will be back where they were at the peak. Now, back in 74, I was thinking how much money a lot of guys made if they had any money to work with when you're near the bottom. I mean, people doubled and tripled their money from 74 up through 78 when stocks rebounded. And now we're talking about the general market itself. I think the lesson learned is dollar cost averaging works every time. And if you've got any money, if you haven't sold out, or even if you have sold out, you're lucky enough to get out and raise cash, you have to be thinking about putting more money into the market at these kind of levels, because I think we're within probably 10% of the bottom. If you can buy them 10% of the bottom from the bottom and sell them 10% from the top, you're going to be a wealthy investor, no question about that. So I think we're close, and I think it's time to try to look around, find some cash, and do a little averaging down.
Yeah, it's interesting, Jimmy. Since 1929, if you started to buy down 20%, that would have been at 3,800 on the S&P at 3,800, which obviously we got down to, the low 3,600s here. So you got a bonus buy here. But at that 3,800 level, typically 12 months forward, the market is up 9%. That's 4,100. So from these levels, it would be up 14%. And then if you go out a year and a half, it's up 13%. So just like you said, you can't sit by idly, and they're definitely, you got to keep your feet moving. So hope to, if you guys got questions, you know who to call here. We got Jim, Dick, and myself, and everybody else. And our motto: 2 rings, no waiting.